Good evening, traders and investors. Will back here with another one, coming to with a Monday market recap. Hopefully you guys had a very good day in the markets today and that you had a very beautiful weekend as well. And in today's action, the S&P and the Qs actually ending higher. We got some news over the weekend that Trump was supposed to impose potential 100% tariffs on Canada. So far, no indication of that. And we also got some news that there was a possible impending government shutdown by the end of the week. But markets were able to actually buy the dip off of those two pieces of news. The futures markets were bright red last night, and the bulls managed to somehow buy it back over the course of the day. And we're currently sitting not too bad on the S&P, the Qs, and most of the market had some pretty decent breadth today. But it's going to be a huge week, guys. Massive amounts of earnings and a Fed meeting on the Wednesday session. So in today's video, we're going to prepare for all of it. Speaking about today's video, number one, we're going to go through a few key pieces of news that I found were very interesting today. Number two, we're going to be going through two company earnings that I prepared for you guys today. Number one is going to be ISRG, one of my favorite companies in the market. I don't talk about it very often, but when they do have earnings, we do cover it. And then we'll be covering Intel earnings, which also had earnings last week. So after those two earnings reports, we will quickly cover our market indexes, the S&P, the Qs, and most of our minor sectors. Take a look at the rotation, where the money is, where the money is not. Thereafter, we will take a look at big tech names because we know a lot of them are reporting this week. Specifically, we got Microsoft, Meta, Tesla on Wednesday. You got Apple on Thursday as well, and so many other large companies in between. So we'll have a quick glance at our big tech list. A lot of names performed well today, but some were down. Which of these names are well positioned into their earnings, and are they buys? Or should we perhaps be waiting until after the earnings releases? We'll take a look at our big tech list rundown again towards the end of the video. We'll be taking a look at our biggest gainers and losers of the day, of which, of course, there were many. The space trade taking a hit to the downside today. Some of the critical minerals trades taking a hit to the downside as well. But there were several names that actually performed really well today. Cybersecurity coming back a little bit. A few of the data center plays having a pretty good day. So we'll take a look at this biggest gainers and losers list at the end of the video and derive any trade opportunity ideas that could be found therein. And at the very end of the video, we'll be taking a look at my portfolio for just a quick little recap of which positions I'm still in. Not too many positions for me to start off the week, any new positions that is, but we've been making some decent money farming, premiums with the wheel strategy over the past few weeks. And I'm coming into this week with a decent amount of buying power, just so I can kind of sit on the sidelines a little bit, wait for the big tech earnings, wait for the big volatility catalyst to come behind us at that point, and then position thereafter. So we'll take a look at my portfolio and see where we stand in terms of the positions for the YouTube trading account. That being said, that'll be everything for today. I know it was a mouthful and a big introduction, but if you guys want to skip to any portion of the video, feel free to take a look at the timestamps in the video description if you want to watch a certain portion. So that being said, let's jump right into it, shall we? The S&P up 0.51, the Qs up 0.44. Decent day of market breadth. Taking a look at the heat map right here, you will see that most major sectors did participate. You had some declines in NVIDIA, Micron, AMD, Intel, but for the most part, semiconductors didn't have too bad of a day. Big tech was largely mixed, but we know a lot of this price action, at least in the short term, won't matter too much because you got four very large companies reporting this week. But the bottom half of the market showed up in a decent way. The banks and financials, decent day. Healthcare, decent day. And the bottom half of the market, although mixed, did show overall bullish performance, as many more names in the market were green than red today. Take a look at your one-day relative, you'll see that even better. Most of the market was indeed higher, led by communication services, technology, financials, utilities, and healthcare. Some names to the downside, cyclicals, real estate, industrial, things of that nature. Just some casual rotations, no big red flags in my opinion. On the 1 week relative performance, guys, you can see that materials and energy are still carrying the markets. Two very key themes for 2026. We've spent a lot of time throughout the month of January describing the key themes for 2026. So hopefully you guys have been paying attention to those as well. And to the downside, some, thematic names here, such as real estate, industrials, and financials coming down overall just a little bit, guys. But we're not that bad, right? On the 1 month relative, guys, as we kind of approach the end of the month of January, looking pretty good. Market's fairly broad, right? And we can take a further look at some of the market breadth indicators just to recap where we are. Percentage of stocks above their 20-day EMA, 61% towards the healthier side of things. Percentage of stocks above their 50-day EMA, the institutionally watched moving average, that is 65%. Very solid market breadth, right? When you have very solid market breadth here, especially in terms of the long-term EMAs, well, it's very tough to unwind such a market. You need a pretty big news catalyst to really send the entire market tumbling. Natural rotation will be had amongst different sectors, but to send the entire market down, you're going to need something big. And so far, we just don't have that just yet. And percentage of stocks above their 200-day EMA, same concept, 63%, some of the healthiest overall market breadth that we've really had since 2024, if you can believe it, right? Better than all of last year in terms of the amount of stocks above their longest standing moving average, the good old 200-day EMA. So overall, not a bad day in the markets. But before we continue into our technical analysis portions, let us do a quick little recap of some of the news events that we have to watch out for today and into the rest of the week, of course. Well, in terms of macro things you got to look out for, guys, not much in terms of news today nor tomorrow, although tomorrow we do have the Consumer Confidence Index. It'll be Wednesday, the big day, with Jerome Powell delivering, well, not an interest rate cut, but his commentary on the overall status of the economy, the jobs market, inflation, potential GDP, right? So the pre-written statement is probably going to be a non-factor, guys, because we're not really expecting an interest rate cut at all. The probabilities are very low. Matter of fact, the next time you might be able to expect an interest rate cut, well, at least what the market predicts, would be in the month of June. Take a look here. The January, March, and April meetings are slated to be non-events for any interest rate cuts. The next one could potentially come in the month of June. And as you can see right here, the market's only pricing in 2 interest rate cuts, one in June or July, and then possibly one later on in the year, such as in the month of December. So until that changes, right, well, we're not going to have to look forward to any meaningful decisions by Jerome Powell over the next few months. However, his commentary when responding to Q&A about the economy, the jobs market, that's probably what's going to move the market on Wednesday, but it is still a volatility event that we have to pay attention to. Moving on into some news headlines that happened over the weekend and today. Of course, we know we talked about this one yesterday, Trump threatening 100% tariffs on Canada over the China trade deal. Now, this, of course, comes after Mark Carney, the Canada's prime minister, was in Beijing on January 16th for their visit, whereby Canada slashed its 100% tariffs on Chinese EVs down to 6.1% for 49,000 units yearly. Not too bad at all. In turn, China eased duties on Canadian canola, lobster, and peas. Carney, however, pushed back on Sunday, stressing that no free trade agreement with China is planned and citing the USMCA rules. I will remind you, the USMCA contract is up for renegotiation this year in a few months amid his Buy Canadian policy to boost domestic priorities. And you can see here, he actually released a video specific to that topic saying that he's buying Canadian and building Canadian as well. So President Trump not too happy about Canada's visit with China and importing some EVs into the country, as the president does not want essentially Canada to be a proxy dumping ground for Chinese either electronic components or vehicles into the US markets. And that's the reason why the tariff threat was made. But we will see whether or not these tariffs actually go through, or whether or not there are further negotiations, but it's something to pay attention to. Moving on further here, the government shutdown probabilities continue to increase. 78% odds that the government will shut down, at least in part, by the end of this week overall. Of course, we know now that it's because of the ICE operations that are carrying on, more specifically in Minnesota, whereby, unfortunately, a federal agent killed a man named Alex Preddy. And as a result, the Democrats kind of banded together and refused to push more funding for DHS and ICE. However, I will remind you as well that ICE does have a lot of budget to work with. Even if the government does shut down, they will continue working, as they did get a $75 billion funding round as part of the big, beautiful bill that was signed last year overall. So we will see. This could spark some volatility in the markets overall. This is an evolving story, so we will have to keep up to date with this one as the week moves on, but definitely something else to pay attention to. Now, switching gears a little bit, we got some other news. More tariff news. Trump is increasing tariffs on South Korean goods to 25% from 15%. This piece of news came in right after the market closed today, around 5 p.m. Eastern, saying that although they struck a deal with South Korea in July of last year, unfortunately, the Korean legislation hasn't approved the deal on their own side. So there were some very favorable terms between America and South Korea discussed last July, but because, quote President Trump, the Korean legislature hasn't enacted our historic trade agreement, which is their prerogative, I'm hereby increasing South Korean tariffs on autos, lumber, pharma, and all other reciprocal tariffs from 15 to 25%. So once again, more tariff news to pay attention to. This time, focus is on South Korea. So this is once again going to be an ever-evolving story to pay attention to, just like the Canadian tariff situation as well. Although the markets did not really respond to this one in the after hours, you can see that the futures market right now is still slightly positive. Moving on further to some other specific news, this time more White House releases. The Trump administration proposing keeping steady the rates that Medicare pays insurers. Now, this is a big disappointment for companies like UNH, Molina Health, Humana, and other health insurance providers. The specified target rates for this year was to be 4 to 6%. And unfortunately, with this proposition, well, it's only going to be an increase of 0.09%. Now, this matters a lot, guys. These Medicare Advantage rates are crucial for these health insurance providers. Essentially, it's a form of government subsidy that is paid to the health insurance providers. We know that the cost of medical services go up every single year, and as a result, the medical issuers have been seeing rising costs of medical services. However, the reason a lot of them went down over the past year is because the Medicare Advantage rates were kept roughly flat or just weren't going up as fast as the medical insurance rates. Let me take the chart of UNH, which is currently down in the after hours, about 9% on that move. And I'll just tell you what's going on here, what has been going over the past few years and why there was a big decline. They're getting squeezed in the margins. Your medical services rates are going up like this. Companies were only able to increase health insurance premiums for customers like this. Medical service rates are going up higher, right? And their subsidies from the government are going like this. So all of this, they have to eat in the margins, right? They're just not making enough money from the subsidies, right? And they weren't able to increase insurance premiums to consumers fast enough, all while you have inflation and other costs associated, other reasons why Medicare costs are rising, which is put a big squeeze on margins, which is why all these charts look the exact same. You take UNH, you take Molina Health, you take Humana, et cetera, et cetera, et cetera. They've all kind of been suffering the same fate. You take CNC, Centene Corporation as well. They all look exactly the same because they got crushed on EPS because their profit margins are being squeezed by these rising medical costs and unfortunately a lack of government subsidies. This is just one further push against the health insurance providers. As we know, President Trump has been talking about bringing rates down for health insurance providers as part of the affordability measures that they're trying to tackle into 2026, which is a big talking point for most consumers, the area of affordability in a midterm election year. So this as well will be an ongoing story. Moving on a little bit further here, Nancy Pelosi just filed $69 million worth of new stock trades. Yes, the greatest investor of all time, beating out returns even she beat out Warren Buffett, but let's be honest, it's not her. It's her husband making all these trades, Paul Pelosi, ex-hedge fund manager, very, very good trader in my humble opinion. The trades that were made today, because I know a lot of people like to track this stuff, selling $50 million of Apple shares, but replacing those shares with $500K of Apple Leaps, selling $5 million in shares of NVIDIA, however, replacing those as well with $250K of call options in terms of Leaps, selling $5 million worth of shares in Disney, but no Leaps associated with that. And newer positions, $500K of Leap options in Google and $500K of Amazon Leap call options as well. So those are just the new trades made by good old Nancy Pelosi. And this may be one of the final times that we get to see some trades by Nancy Pelosi because she's retiring soon. And after she retires, there's no need to formally disclose these trades that her husband is making on her behalf. So that being said, guys, take from this what you will. I like that Amazon trade. I also have a lot of Amazon Leaps as well. Not 500K worth, but, we'll see what happens. Moving on further here, guys. Nike's currently cutting about 775 jobs as it ramps up automation at its U.S. distribution centers, with most of the cuts tied to facilities in Tennessee and Mississippi. I thought that was notable because in the age of AI and automation, even a company like Nike, right, is starting to cut a little bit of employees. So we will see if it has any efficiency gains for their productivity. Nike has been down, 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 down. And unfortunately, this piece of news didn't really do too much for them today either. Still down about 0.08% on the day. Moving on a little bit further here. NVIDIA investing $2 billion more into CoreWeave at $87.20 per share. So at least if you bought under that, you bought under NVIDIA's current round. But I will remind you, NVIDIA already has somewhere between $5 to $10 billion invested in CoreWeave pre-IPO. So NVIDIA is averaging up on its cost basis as they are the largest private placement, or rather, NVIDIA has a whole segment of side bets just like Google. CoreWeave is their largest position in that a side bet position there, but this one did lead to some increases in gains in CoreWeave. So interesting that, you know, I mean, it's kind of like they need CoreWeave to win because CoreWeave is one of the largest customers for NVIDIA in terms of the data center RAM. So no secret here as to why that partnership is crucial for NVIDIA. Just another $2 billion today. I thought that was interesting for everybody who's invested in CoreWeave or other data center plays like IRN, Nebius, and things of that nature. Moving on a bit further here, we've got some news out of Microsoft. Satya Nadella, CEO, coming out this morning and saying their new TPUs are ready, calling it Maya 200 online in Microsoft Azure, designed for industry-leading inference efficiency. It delivers 30% better performance per dollar than current systems, with some pretty decent specs, saying it joins the broader portfolio of CPUs, GPUs, and custom accelerators, giving customers more options to run advanced AI workloads faster and more cost-effectively on Microsoft Azure. Now, once again, it brings back the age-old question of what's better, a TPU or a GPU? Who's going to have most of the market? Well, if you're a spec nerd, well, you may want to take a look at these statistics right here. Take a screenshot because I won't be going over these every single one of these. But, you know, you got the Microsoft Maya 200s. You got the Google TPUs, which caused a ruckus a few months ago, right? The whole GPU versus TPU debate. You got the Amazon Trainium 3 chips, also TPUs. You got Blackwell as a benchmark as well. Look at Vera Rubin, man, in the second half of 2026. Look at some of their performance. All, by the way, 3-nanometer architecture here. Look at some of the performance here. In terms of the NVIDIA Vera Rubin chips that are coming out soon, it's like not even close. Way more bandwidth, right? Way more scale-up capacity. So way more performance essentially as well. So although TPUs do have their place for specific workloads, of course, GPUs known to be the more broad tool with more versatile applications, whereas TPUs kind of have to be programmed and set for certain very specific tasks. I'm not saying they're not good. They have their place in the industry, of course, but to say that they're going to replace all the NVIDIA GPUs is probably a gross overestimation. And that wraps up all of your key news elements. Obviously, there were more, but those are the ones that I figured would be most interesting to our discussion. Now that that's out of the way, let's dive into some earnings, shall we? So company number one for our earnings presentation is going to be ISRG, Intuitive Surgical, one of my favorite companies in the entire market because of their moat, guys. This is a company, if you don't know what they do, they are basically surgery-assisted tools, right? So they're very large machines that allow surgeons to effectively conduct surgeries with very, very good accuracy with these very small little tools, all in a they're not automated, but you can say that they're somewhat semi-automated depending on the product suite, but a very decent margin business as well. And they have a dominant market share, 65 to 80% market share control for the industry. As a matter of fact, the only really company that competes with them somewhat is Stryker, but largely people do prefer, at least people from the medical industry do prefer ISRG's machines. They're just better, and the company does have pricing power. It's a very sticky product as well. The time to retrain any surgeons away from these machines is very high, and these have its three main competitive advantages that I look for in a long-term company. Significant market share, dare I say a monopoly or duopoly, right? Market-leading tech by far, and it's probably not really close at this point in time. It is also a subscription model. They make revenues when they sell machines, but also servicing of these machines because only they can do it. And then obviously time to train surgeons. It's tough to replace the product, right? So these are all characteristics that I look for in long-term investments. And hopefully after I show you this presentation, maybe you would also be interested in ISRG. But quick little disclaimer here, guys. The stock price is not cheap. Sometimes when you find companies with very strong moats and very strong competitive advantages, the valuation is not cheap, and ISRG is no exception to that rule. That being said, they crushed earnings. Again, 11% beat on EPS and a 3.75% beat on revenue as well. I spent a good portion of 2025 building into my position. It's one of my newer positions in my long-term portfolio. Many companies in my long-term I've held since 2017, 2018, 2019 is when I built the bulk of them. But this is one of the newer ones that I was building under the 500 range. I haven't bought some above 500, but I may be nibbling a little bit more up to a fuller size position. But that being said, very strong earnings, guys. Take a look at some of the numbers here. Their revenue, that was up 19% year over year. The amount of procedures that they do with their machines, both Da Vinci and the Ion machines, up 18% year over year. super strong. DaVinci was 17, Ion was plus 44. Although Ion has a smaller install base and costs less, the DaVinci ones are truly the the key core product for the company. DaVinci placements up a lot, 12% increase in the installed base, now to 11,000 machines across 8,000 different hospitals. And now more Ion machines as well, almost up to 1,000 units overall. DaVinci procedure growth, forward outlooks, 13 to 15%, very solid. And gross margins here, guys, 67 to 68%. ISRG is a company that's just been improving its margins over the past few years. You can see in 2023, it was about 25% net. And now we're kicking on the door of 30% net margins. At least over the past few quarters, you've seen very strong high 20s in terms of margins. So margins is not a problem for them, guys, at all. Take a look at gross margins right here. They're always mid 60s. Take a look at operating margins. They're now up to about 30, which is very good. And thereafter, net margins get translated to about high 20s overall. So very strong company, very good margins, and very strong products with very good competitive advantages as well. Take a look here at the DaVinci installed systems base, very strong, up to 11,106. And it just keeps rising, both on a US or North American basis, but also worldwide. And I'll show you guys some of these statistics here from the DaVinci machine. So here is your presentation from the JP Morgan Healthcare Conference in 2026, which was the 14th of January, about a week before their earnings, but super strong. Here are all the machines that they do. As you can see, most of them are DaVinci machines, with the new product here being the Ion suite of products. Take a look here, patients, 20.4 million going vertical right now, and that's across Europe, US, Asia, and the rest of the world. All operating segments are moving higher, looking very good. 70 plus countries you can find these big machines in, 3.2 million plus procedures. That is very, very, very strong here. 4,000 peer-reviewed articles, 1,900 intuitive systems placed in 2025 alone, and total procedures so far, 20.4 million, with now 12,000 intuitive systems installed in hospitals globally. Super strong here, guys. Very good net promoter score for the business as well. Very strong recurring customers. The people that use these products, namely surgeons, do love them a lot. You got 19% total procedure growth through 2025, 13% total installed base, as we said, and $10 billion in overall revenue, with 84% of that being the good old juicy recurring revenue metrics. As I've said before, if you take a look here at some of the statistics, they make money from instruments and just selling the actual instruments. This is true, but they also make money from services, as they have to service these machines, and systems operating revenues as well. As we know, these machines use a lot of software, and that software does come at a price. So yes, they have an upfront cost for the machines, which gives them good cash flow, but they also have that juicy recurring revenue. Very strong business model, in my opinion. We won't go through all of these machines, but just so you guys can see, right? Strong global DaVinci 5 launch in US, Korea, Japan, and Europe. 270,000 procedures performed to date. Very, very strong numbers. 10,400 plus surgeons using the DaVinci 5 machines overall. Super strong, guys. There's really nothing to say that's bad about this company. You look at all of their metrics, all of them are moving higher. Even they have simulations that they're doing right now. They have case insights as well, based on previous cases that have been ran on ISRG machines. And ISRG, guys, I mean, they don't talk about it here, but when you look further into the details, this could be one of the first companies that starts doing actual automated surgical procedures, which is very interesting. It's still a while away, talking about like 3 to 5 years away, but this is a company that's heavily working on robotics and AI automation in the medical industry to make some of these surgeries basically surgeon-free, to where the machine actually starts doing everything, but it has to learn from a lot of these procedures, and they're getting more and more of them on a yearly basis. You can see here year-over-year growth for procedures, super strong, guys. Look at this breakout year 2025. Installed base keeps growing, utilization keeps growing as well. Just overall, an extremely solid company. So when we're looking at a company like this, guys, yes, it is expensive, but it's expensive for a reason. They have very strong competitive advantages. They do have a recurring subscription service model for their software, but also for servicing of the machines. They have a lot of pricing power because they are the best in the game. And as a result, the market has always given them a premium valuation. If you take a look at the past historical PE ratios right here, you will see that it's very rare, at least over the past 5, 6, 7 years at this point, to find this company trading under a 50 to 60 trailing right? And even back here to 2017, it was still trading expensive on a trailing PE multiple. So this company has not been cheap for a while. It does trade within an expensive band in terms of forward price to earnings. Now, that being said, there are certain key areas where it does become interesting to buy. And for me, at least where they are in the stage of their current development, that is between $500 and $400 is my sweet spot to keep accumulating this company. I think there's great forward growth for the business, at least through, 2035. And currently as it stands at a $187 billion market cap, although it does trade rich right now at 530, it trades at a 3.5 peg. It trades at a 16 forward price to sales and a 53 forward price to earnings ratio, which is why I'm not saying the company is cheap, but it is a company that I do believe will be here for the long term. And when I'm looking for strong companies with very large moats, I want to be buying these 30% sell-offs from the top when the business is still pumping out great fundamentals. If we're looking for the best possible buy, we have to go with the best possible historical moving averages. Every time we come down to this 200 weekly EMA, it tends to be very strong buying opportunities for the business. The last time we came close to it a few times was all the way back here in the month of September, which is an area where I did buy a lot. If you see it again this year, I'm not saying not to buy up here. I'm just saying if you buy here, you may have to DCA down if you're interested in this one into the 400s. If somehow we get a market crash this year or some sort of a correction, ISRG is one of the first names that I look to build my position, as this is a company that I want to hold for the next 5 to 10 years. I think they're doing fantastic in terms of, I think they're doing a fantastic job with their current machines, but also the division of the business that nobody's talking about is the automated robotics portion, taking these machines, which are currently operated physically by surgeons, and the next step will be to possibly have these machines doing surgeries all on their own. As I said, that is still a ways away, but this is the company that is the closest to being able to achieve that level of automation because they have so much data to train their data sets on as well, right? So this is a nice company. It is expensive right now, but in my opinion, it is something that is nice to hold if you are in the entire medical devices space and if you're looking for something of this nature in the healthcare landscape. So that's everything for ISRG. Hopefully you guys enjoyed that. Now we're going to switch gears here and come to this good old company, good old Intel. Intel, down 17% the day after their earnings on Friday and down another 5.72% today. Intel actually had a beautiful start to the year, guys. If we were looking from the start of the year to the top before earnings, the company was up 49%. Very strong start to the year. And now they've given back roughly half of that. So at $42, I'm sure many people are wondering, is Intel a buy? Let's take a look at some of their earnings metrics here. They did beat on EPS. They were expecting to come in with negative EPS. They actually came in very decently, beating the expectations by 84%. But then again, guys, it's a few pennies, right? So this beat is not that great. And then the revenue was up 1.8%. So the EPS beat looks substantial, but I will remind you, right, that Intel literally lost all of their EPS a few years ago, which is why it came down so much. So when you're coming off of zero, it's quite easy to beat your EPS, isn't it, right? So they're doing a good job of trying to get the EPS back, but still a long road to recovery. Revenue as well, very soft heading into 2025, but we're looking for the inflection point. We may have achieved this inflection point so far, which is why more and more people are interested in Intel overall. Well, that and the fact that they also have a tremendous amount of government investment, $8.7 billion, 10% equity stake at $20.50. The US government's up 2x on that investment. You got $5 billion from NVIDIA and $2 billion from SoftBank as well. All of those investments made last year in Q3, which is why most people were trying to come in behind some of these big players and also bet on Intel's recovery story. So how is Intel's recovery story doing and why did they drop so much? Well, let's have a look. In terms of your quarterly highlights here from Intel, you can see that their revenue, it did beat the expectations, but it was still down 4% year over year, guys. So still struggling for revenue expansion. And we'll kind of explain why. It's because some of their divisions are just still not doing well. Adjusted gross margins also down 4.2 percentage points year over year. It's been a margin story, an EPS compression story. No secret there. The current CEO, Lip-Bu Tan, is doing the best that he can with a unfavorable, set of cards in his hands, right? Last year, I'll remind you what he did. They fired 15,000 employees, trying to reduce their operating expenses by $17 billion into these next 2 fiscal years. Cost cutting for many fabs, producing only for demand, whereas before Intel was just producing as much as they could, and nobody was buying. And then Lip-Bu Tan said he would approve all the chip designs himself. These were the major key points when he took the reins as CEO last year and his turnaround story for the business. So let's continue, right? The Q1 guidance is the reason why the company was down so much. Revenue guidance came in very light, $1 billion under the expectation, 11.7 versus the 12.7, or sorry, 11.7 to 12.7. The midpoint being approximately, let's call it, 12.2, and the expectation was 12.56. So excuse me, under the estimate by about 300 million there. Adjusted EPS came in at 0 instead of being 5 cents. So still struggling with these margins. And talking about those margins, adjusted gross 34.5 versus the estimate of 36.5. These three things, I mean, you can't miss on revenue and EPS and adjusted gross margins and think the stock is going to go higher, right? So was it an overreaction? Maybe, but I'll remind you, the stock was up 49% since the start of the year. So was it an overreaction maybe to the upside to start the year? And this is just maybe a normal return to casual pricing. I mean, the stock is still up 22% year to date, right? So it's still doing better than most stocks in the market. And segment trends, sadly again, client compute group, again down 7% year over year. However, their data center and AI division is up 9%. This is the best segment of the business. And I will show you, we can see some balance sheet highlights right here. You can see that Intel, despite their issues, despite the fact that they are sitting on a lot of long-term debt, $44 billion to be specific, they do have a lot of cash on their balance sheet as well. I mean, it does help that, a lot of companies just gave them money recently, or rather invested in them. So that's always good. Some equity raises, right? Or some, equity investments right there. And then of course they have a little bit of long-term investments as well. That's that 8.5 billion. So the balance sheet is not terrible. I figured I should show you this, guys, because it's not all bad with Intel. Like, they do have enough cash to weather the storm that they've put themselves in over the last few years. Moving on a little bit further here, this is another problem with Intel. You take a look at revenue and free cash flow. The revenue, as we saw, came down into 2022 and really never recovered. It's just flat. They're not really doing anything. We could be seeing some acceleration over the next 3 years, but are we talking about meaningful acceleration? No. I mean, the current CEO said it best, right? It's like trying to turn around a massive cruise ship. You can't do it on a dime like a speedboat, right? It's going to be a very slow process turning this company around. And free cash flow is still not back to positive. They're still hemorrhaging free cash flow, which is why I showed the balance sheet as well. So they do have cash to weather this storm and weather this turnaround. But, Intel's got to do a lot of things better than it is right now, but they're on the right track. That is something I can say. They are on the right track. They got some investments by the US government, by NVIDIA, by SoftBank. So, many people do believe in the turnaround story. Moving on to some of their earnings presentations highlights. I mean, there wasn't that much to highlight, honestly. The revenue was down year over year, 4%. We talked about the gross margins, and the EPS was kind of the highlight of the quarter. But I mean, take a look at this, right? Here's your revenue. I mean, it's just flat over the past 5 quarters. There's really nothing to say. Gross margins are also just not improving that much. I mean, decline from last quarter. I mean, I guess they're up versus Q2, but is that really saying something? So, I mean, they're doing better, but you can clearly tell by the numbers, right? It's going to be a slow, this chart shows it best, right? It's going to be a slow and methodical recovery of revenue, of EPS, of margins, and free cash flow. So keep that in mind if you're investing in Intel. I know everybody wants to see the snap instantaneous gains, and that can happen sometimes in the market, but if you're looking for the fundamental recovery story, like, it's going to take some time, right? Client Compute Group, this is the worst division for Intel, in my humble opinion, because let's be honest, they've been getting killed by AMD over the past few years. Everybody knows it. No need to say it out loud. Segment operating margin, that's just been steady down from 36 down to 27. Revenue's been flat or declining, and operating income also flat or declining as well. The data center AI is their best performing segment. I mean, it should be. Segment revenue up sequentially quarter over quarter and year over year as well. Operating income also up and to the right, and segment operating margin. This is where they're excelling, right? Segment operating margin is up 2x, more than 2x, 3x to the same period of time in 2024. So that's good. But then here you go. Here's the biggest loss leader of the entire business. Once again, the Intel Foundry division. This is something that Lip-Bu Tan is trying to make a big push in terms of pushing around. When he says only producing for demand, this is what he means. They're tired of hemorrhaging money from the foundry business with underwhelming products. That being said, we'll see what they can do in the near-term future. Intel Foundry is still flat in terms of revenue, but look how much money they're losing. Operating income at a loss, $2.5 billion every single quarter. Operating margins negative as a result, 55%. So it just cost them too much money to make what they're producing right now. And as a result, you really got to focus on, and there's our all other segment, Mobileye and Altera. I mean, look at this disaster, right? So they got a lot of things to work on. They got to work on their foundry business. They got to work on their other bet segment as well. They really got to work on their client computing division, trying to get some better competing products out there to rival what AMD currently has. It's really only their data center and AI business that's carrying the business right now. So that being said, is Intel a good stock to invest in? Well, it depends on your time horizon. It's just like UNH, right? When somebody asked me about this stock, I mean, yeah, it's a long format recovery story. Intel is better because, you know, there's some similarities. UNH has the Buffett factor inside of it. Intel has the US government factor inside of it. So, I mean, I guess there's that. But hey, I mean, no risk, no reward, right? I guess sometimes if you want to bet on these recovery stories, you know there's going to be some risk, but there could be substantial reward if in a few years Intel comes back to their former greatness, right? We can take a look at their forward PE. It's currently trading at 79.25. Very normal. Their EPS is almost nothing, but I did show you guys this is what you got to pay attention to, right? They're coming off of 0 EPS. So obviously this chart is, you know, the PE is going to make sense when you're coming off of 0, right? That being said, revenue, the inflection point is here. We're not talking about massive NVIDIA acceleration here, but it is reaccelerating. The next few years flat, but supposedly, analysts have penciled in a big year-over-year growth recovery from 2028 to 2029. You know, these 2 years is like 7%, 6%, 7% revenue growth every year for the next 2 years. But then, supposedly, a big 20% uptick in 2029 as the foundry division comes back online, and supposedly their client compute group could do a little bit better. That being said, it's trading at 1.2 peg. Just divide this price to earnings ratio by their EPS growth rate. EPS growth rate looks fantastic, but that's because, once again, they're coming off of 0, right? And this revenue growth rate doesn't look too bad, but keep in mind, that's because you got 7% in 2027 and 2028, but then 2029 is supposed to be a 20-plus year. So that's why it skews a bit higher here on the average when we derive a simple average. Price to sales, I mean, it's a 4. It's under 4. It's not too bad. So all things considered, is Intel quote unquote cheap down here? Well, it's not expensive. I wouldn't say it's as cheap as it was clearly at $20 when that was the real good time to take the asymmetric bet on Intel. And we talked about it on the channel last year. But let's say you didn't see it, or you were waiting for more information, or you're waiting for the inflection point, so to speak. Is it a bad idea to be looking into Intel between the low 40s to about mid 30s, which is big support down here? No, it's not bad, but should we be expecting that every month is going to look like the early stage of January, where we just go up massively? Probably not, right? So that being said, would it be a bad thing to accumulate some positions between 40 and 35 if you have a time horizon that extends beyond 2027, 28, 2029, you want to give the company a chance. You're going to get behind the US government, behind NVIDIA's investment, behind SoftBank's investment. You can. Is it my favorite trade in the market? No, but is there an investment thesis here for a further recovery story? The answer is yes. Would it be a super heavy play for me? No, but would I throw a couple $1,000s at it and see what happens? Perhaps, right? But it would still be okay, like it gets like a B plus or like a B grade from me, right? A plus, A minus. It gets like a B or maybe a B plus. That's as good as it gets, right? So that being said, take from that what you will. That's everything I had for you guys for Intel earnings. Now, let's jump into some charts. I'm going to start off with the good old SP 500. So the good old SPY and the indexes, we're not going to spend too much time on this, guys, because I want to fly through the rest of the technical analysis portion of the video, and nothing much has changed, right? Your line in the sand level is still 677, so pay attention to it. No new all-time highs, daily downtrend. The bulls are trying to get it back. Well, actually, okay, an uptrend, got a downswing. They're trying to get the uptrend back. Overall, this is a fake news candle right there. You can see it best on the futures. Didn't really set much of a higher low. You never really lost your hourly trend in that whole segment. But that being said, guys, okay, the clearest time frame for me is still the weekly. It's just been very, very tight price action up here. We know you got a lot of bullish tailwinds for the market overall, right? That we talked about several times last week, so I won't bore you with them again. However, that being said, okay, so pay attention to this weekly, right? It's just a very, very, very tight range of price action. In my opinion, the one thing that's going to get us the break up or break down, well, of course, you guys know it, right? It's going to be big tech earnings this entire week. Microsoft, Meta, Tesla, and Apple. Look no further than that. Those are the ones that could break the range or possibly send us down. If you get a breakdown here below the weekly higher low, which is currently 676, we got to pay attention, right? 673 down to 668. That is the 26 weekly EMA. We have not tested that in a very long time, matter of fact, since last January, or obviously the tariff sell-off. But in a big bull market with no black swan catalyst, traditionally, that's when you got to get a bit of a sell-off, and you would be looking for a bit of further monthly consolidation, which would be natural for the markets, but that'll all rely on big tech earnings. So I don't want to pronounce myself too much on speculation. Just know that if big tech does well, you probably get an all-time high break and follow through. They will have good earnings, in my opinion. Whether the market sends their share prices up or down, you guys know earnings is always a casino, but just pay attention to that. QQQs, same concept, right? QQQs has been stuck here for seemingly forever, since October pretty much, right? No new highs and not many new lows. It's been a tightening pattern here for the past 3 months overall. So pay attention to your levels. Line in the sand, 607.91 on the weekly. If you lose that, you're going one level lower, which is pretty much 597 down to about 588, the 26 weekly EMA as well. And it would just be very healthy monthly consolidation. So pay attention to it. The reason why I'm not going so much into detail is simply because you have big tech earnings. It's very simple this week, guys. It's super simple, right? Big tech earnings do fantastic, and it gives us a bit of rotation because we know, companies like, it's very simple. We'll go through them later, right? But Microsoft is 20%, 15% off its highs. Meta is, 15, 20% off its highs. Tesla also is about 15% off its highs. And then you got one more. Apple is also 15% off its highs. If all those earnings do really well, which I think they'll do really well, and the market actually gives them the pump, well, quite simply, guys, you will have the breakout. The bias is still bullish in my opinion, because there's nothing wrong with these big tech companies. They've just had normal periods of consolidation. So keep that in mind. This week is all going to be dependent on that big tech price action. Moving into financials right now, financials still struggling here to recapture the trend. Daily continues into a downtrend. We're kind of losing support a little bit. We'll see if they can get it back. Ends at 53.19 to the top of 54.42. And if you lose that, we're coming down to the big one, right? The very big one, as a matter of fact. Big previous resistance, support. This is like 6 months of price action, right? The clearest time frame, in my opinion, is just the monthly. Just looking for a bit of a monthly higher low right now. Some of the banks are a bit extended. We're now getting some consolidation. Bank of America consolidating a little bit. JP Morgan, monthly consolidation as well. And then you do also have the credit card players, Visa and MasterCard, not playing along because of the Credit Card Competition Act, the 10% interest rate cap, which, by the way, last time I checked the calendar, it's now January 26th. The interest rate cap of 10% was supposed to go in January the 20th, or if not, these companies were to have some penalties. Obviously, not Visa and MasterCard because they're only networks, but the banks are the ones who charge and collect the interest rates. So far, nothing, but keep in mind, Visa and MasterCard also, and American Express, all have earnings this week, right? So keep that in mind. Those are a lot of the financials plays that I enjoy. Playing Bank of America, bit of a back test here. You guys know the drill. 50 to 48, I am a fan. JP Morgan down here, 290, 280. I am also a fan of some little buys down there. And Visa and MasterCard at their current prices, I am also a very big fan of buying those too. Moving into healthcare right now. So healthcare was up on the day, but down on the after hours because names like UNH are down 8%. So that being said, healthcare also, the clearest time frame here, we can talk about the daily all we want. Daily downtrend, engulfing move, trying to go for the new daily uptrend. But in all reality, the clearest time frame is still the weekly, right? It's a massive tightening range. I know the price action looks awkward, but the bulls are still in control of the weekly, and the monthly also still full control, right? In the event you get a bit of a drawdown here, well, clearly we're going for the 150 to 145 backtest. I've been very clear. This is an area where I'd be looking for more swing trades. Heavier swing trades on healthcare. If they give me that nice retracement on the monthly, I will be looking for it. But as of right now, I'm not playing the index ETF as I was back here with some call options. I've since closed my call options that we bought back here into target number 1 and target number 2, which was the all-time high. And I'm just looking for a reposition. If not, I'm just playing individual companies here and there, just adding to my ISRG long-term position, adding to my TMDX long-term position as well. No other healthcare plays for me currently. Moving on to semiconductors right now. Semiconductors down a little bit. That's because a lot of your big components were down today. NVIDIA, Micron, AMD, Intel, etc., etc. Although some of them did perform well, not enough to lift the SMH ETF. So daily uptrend still very nice right now, right? Just looking for higher lows, still anything above 389.89. Looking for a new higher low, possibly continue the trend. And if you unwind, Well, very simple, guys. The weekly time frame shows it best, right? It's a nice weekly uptrend, looking for a higher low. Down here, probably 375 would be a nice backtest location for possible further longs overall. I am not playing companies that are super extended off of their EMAs. No, I'm rather playing companies that are still, in my opinion, fairly valued, such as Marvell down here. I like Marvell a lot. NVIDIA, I really enjoy NVIDIA down here after its elongated consolidation phase. And the last one that we played was AMD down here in the 200s. Now that is substantially higher. Still decent if we're looking for a 2, 3, 4 year forward thesis, but short term, right? Shortest term timeframes, the entry points were really down there at 200. So now I'm kind of focusing on NVIDIA and Marvell as my two favorite ones, because a lot of my other favorite companies, they just ran too much, right? Like ASML was a massive buy for us down here. It's just too extended now, fundamentally and technically speaking as well. And you got a lot of companies this week that report earnings. Very important companies. Texas Instruments, ASML, but also everybody's new favorite semiconductor trade, the memory stocks, Micron, SanDisk, that good stuff. So you got Seagate. You also have Western Digital here on Thursday, and you also have the big one, SanDisk, on Thursday after the close as well. So that should be very fun for semiconductors overall. So pay attention to what happens there throughout the week on some of these semiconductor niches. On to the Russell right now. The Russell down 0.31%, just normal consolidation in my opinion. Daily uptrend, they went for a leg higher, got rejected a little bit. And you'll notice here, a lot of the high beta, high momentum names and small caps were indeed down today. But keep in mind, the Russell outperformed everything to start off the year. I mean, prior to the last few days of declines, the Russell was up 10% year to date, when the S&P and the Qs were only up like 1. So now they've retraced a little bit, but it's still your outperformer. In the event you flush the line in the sand, 261, you're just looking for natural weekly consolidation, right? Clear breakout here, clear favorite theme in terms of cyclical recovery of growth stocks throughout 2026, because you got a lot of very favorable macro tailwinds, such as good fiscal policy and the big beautiful bill, and further reductions in the interest rate environment as well. You know, so many things coming into play for small caps overall. And the monthly just looks very nice as well. Beautiful monthly expansion as well. So, you know, if we're looking for any swing trades, maybe we would be targeting 254 down to about 250 for a bit of a reentry down there. We'll cover these minor sectors a little bit. We talked a lot about them in the past few weeks as the part of the broad market rotation. So I am still a fan of some value names right here. But the problem with XLP, consumer staples, is we're coming into the top end of multi-years worth of resistance. So that being said, very nice breakout pattern. The XLP is actually one of the outperforming segments of the year, 6.52% overall. And that's saying something, guys. I mean, at the end of the day, these are consumer staples, right? They usually don't move like a growth stock, but they have been doing quite well. So pay attention if you get the back test down there, 80 down to 79, and we're looking to position. Might be an interesting location to reposition. A lot of very interesting value names, a lot of very interesting dividend names in the whole consumer staple segment. So pay attention to it. XRT, consumer retail, same concept as well, right? Nice weekly uptrend and a very nice monthly move as well. So if the thesis is no recession / soft landing / progressive recovery of the consumer, staples and consumer cyclicals could also be two very interesting places to position. You don't have to play individual companies. If you want to play the ETFs, no problem with that as well. Utilities, also one of my key areas this year, but not everything in utilities. No, more specifically, the independent power producers for data center purposes. Names like, you know, Vistra, names like Duke Energy, names like Next Era Energy, possibly names like Dominion as well, right? Should do well because of the data center grid requirements, of course. So those are some of the ones that I'm looking for utilities, but utilities should have a good year, especially in a rate cutting environment, guys. A lot of people buy straight utilities for the yield. And as a result, when the risk-free yield, the T-bills, goes down over time, well, people reposition into some dividend names, and utilities being a big component of sometimes people's portfolios when they're looking for that pivot. Moving on to real estate, this ETF is just a whole bunch of REITs. There are other names in here, but it's largely just REITs. Same concept, right? You know, even though commercial real estate has been doing the best, still ARPUs, which is your, give me a second. No, it's not. It's AFFO, essentially. This is the way to measure kind of the EPS and the growth rates for REITs. should be looking pretty good in a rate cutting environment, guys. So REITs also very interesting. I mean, I have one in my portfolio. There are many that you can choose from. My preferred one is Vici. I know there's a lot of you guys that enjoy investing in REITs. Just make sure you have something that is really quality holdings, right, in an evergreen market. Something that's not potentially disrupted, like a whole bunch of office buildings and things of that nature, right? And lastly, XLE Energy. I mean, energy is clearly going for the breakout right here. This could be a very easy trade, right? This XLE ETF is just a whole bunch of oil and gas companies. We know oil and gas has been very hot this year. Everything from, Chevron possibly going for the multi-year breakout. Very nice monthly uptrend. At least they're trying for it. XOM going for the all-time high breakout here as well. Look at this chart, man. A lot of them, right? ConocoPhillips, also trying to get something going right here. So this could be one time where you've had 4 years of negative momentum. And I know the barrel of oil is not necessarily going to go up this year, but you could see a disconnect of a sector that's been doing nothing for the past 4 years, could possibly be inching higher here over the course of this year. But not only oil companies, but also a lot of people have been playing midstream pipelines, right? Everything from Enbridge or other things of that nature, or Energy Transfer. They offer phenomenal dividends overall, and the outlook is pretty good. A lot of these have direct data center narratives associated with them. So those could be also very interesting plays. So I don't mind oil and gas, but I also don't mind playing something specific like the nuclear sector, whether you go for an ETF like NUKZ or a name like NLR or things like that, right? Uranium and nuclear power could be very interesting. Names like, Constellation on this decline, or other names that we've brought up previously, like Vistra, like anything with nuclear exposure or renewables as well. You can think of solar too. Very interesting themes in energy, but we've talked about that a lot over the course of the early stages of the month of January so far. Now, moving into metals, man. What a day on metals. This was a wild day on metals. So gold broke out above 5,000. 5110 was the high of the day on gold. And then midway through the day, you got a big liquidation break to the downside, right? Possibly just trapping people and running the other way. But the bulls still remain in full control of this trade overall. If we move a little bit lower, guys, and that indeed was a local top, and the keyword is on local top, because we can't call it an absolute top just yet, because the bulls control all the time frames. They control the daily, they control the weekly time frame, right? Higher lows are set. So any moves lower, looking for a higher low. Anything above 45.30, looking for a higher low. Pay attention to how they react to this 12 EMA, because eventually they always do come down to it, right? They've been riding it for so long at this point in time, yeah? So pay attention how we come back into it, and that'll kind of give you some indication. If you just flush it as if it's not even there, set the lower high and the lower low, well, they're going into extended consolidation on the weekly. And perhaps as well on the monthly, because it's a very overbought trade. It's a very crowded trade right now. Obviously, a lot of the elements of the trade make perfect sense. You talk about the de-dollarization, the central banking buildups of everything, right? The distrust in the US dollar, the requirements of these metals, perhaps for, everything from electronics to solar panels to EVs to everything, right? The difference in the supply shortage or whatnot, the artificial shorting of these by JP Morgan. There's so many aspects of the thesis and they all make sense. But at the end of the day, guys, the RSI here on the monthly is 95, one of the highest of all time. The weekly is very overbought. The daily is very overbought. So positioning up here without a pullback is just very greedy in my humble opinion. So keep that in mind. And the same things can be said about silver. A lot of the elements of this trade make perfect sense. Some people say silver is going to 200. Some people say 300. In all reality, guys, that's literally just speculation. You can try and determine how much they can run from structural supply deficits to requirements for solar panels and EVs and all that good stuff, and central banks building up, and the so-called commodities, the commodities in metals super cycle. Of course, we can always say that, right? But what is the risk? What are we doing here? What are we buying? We're buying something at a 94 RSI. This is the highest RSI since the 1970s. Higher than 2011 when you had a similar exponential move, right? It's as high as the 1970s and 80s in terms of total RSI. It's moved up a ton already, right? And then when you see a big volume climax like this, take a look at the volume, right? Big volume climax, gap up, open, and give everything back. It just lets you know that the trade might be getting just a little bit tired in the short term. It doesn't remove the fact that the bulls are in full control of this chart, that they move lower. You're still looking for a higher low, possibly targeting 94, 95, back to the 12. I mean, just look at what the bulls have been doing. They've been grinding this the whole time, right? So if we're looking to buy pullbacks on higher lows with the stop loss and then looking for further expansion, that's a much easier way to conceptually trade these things, rather than just buying at any price when there's peak FOMO. Today, guys, was the biggest, and I will say it, today was the biggest day on record for silver volume ever. And it was one of these, it was the second or third best day of price performance at the highs. From the start of the day to the highs, it was up like, I don't know, at one point today, silver was up what? From the high, like 13, 14%. It's the best day since 2008, right? So sometimes when you see moves like this, it can be synonymous with a bit of a short-term local top as the trade could be getting a little bit exhausted. So buying up here is a lot riskier than buying all the way down there. But I know a lot of people just, they'll just throw risk management out the window and they'll just buy at any price with a thesis of it going up to, $200, $300. And I do wish you the best of luck. No position for me, no short-term swing trades, no long-term investments in silver either. But congratulations. I do have a little bit of gold, not the actual metals, but I do have like physical gold that I acquired a long time ago. I'm fine with what I have. It's not a big position at all. Just two, a couple of four, when gold was like, I don't know, like $1,800 or whatnot back in the day, about like 4 troy ounces of gold. So I have some physical gold. I have no silver. I have no horse in this race, but I wish you guys the best of luck. Chart looks, it looks okay, but we're seeing some signals of exhaustion when you see days like today when they just give back an entire move like that. So just keep that in mind, right? Maybe the trade's getting a little bit tired and you know that eventually, I mean, you have to set a higher low on the weekly eventually. It can't just move vertical. I mean, they set higher lows all the time on silver. Right? They tried for one here, but people bought it up anyways. So we will see. You guys know that I'm diversifying my bets into copper, uranium, and lithium overall. So just because they also have very heavy use cases for electronics and data centers and whatnot moving into the future, robotics, right? EVs, tons of things of that nature. Now, moving on to our crypto names, Bitcoin not doing much. I mean, it was up 2% today, and Ethereum as well, up like 4% today. But in all reality, guys, crypto has just been doing nothing, like literally a whole lot of nothing. No short-term trends here. The daily bears are in control of this chart. The weekly is just going absolutely nowhere. Pay attention to line in the sand breaks. 83.5 on Bitcoin. You really don't want to see us lose that. If not, you will get the new leg to the weekly downtrend and maybe even revisiting 74 down to 65. And on Ethereum as well, just no clear trends, right? The bulls are just nowhere to be found. They have to start everything from scratch. And if you lose this area right here, close below 2750, it's not going to look good. It'll just be kind of like a weekly extended bear flag into further follow through. Unfortunately, the monthly move would not be done at this point, and we may just head lower to about the low 25 to 2100. So these trades are not swing. There's no momentum here. Let's be honest, right? There's no momentum at all. So there are other names to be playing for shorter term swing trades. But if you have a long-term thesis on Bitcoin and Ethereum, it's still just in long-term accumulation phases of the market right now, with there just being no action in terms of no momentum holding up any short-term trends. That's everything for your overall market rundown. Hopefully you enjoyed. Now let's spend 10 minutes on big tech, and then we'll spend 10 minutes on the biggest gainers and losers of the day. All right, so first moving into Apple here, up 3% on the day. No real news whatsoever, guys. I mean, they'll be doing Apple Siri and Gemini in a couple months. There was that piece of news, but that's nothing new. Overall, though, guys, we're just bouncing out of short-term oversold conditions and reacting nicely from the 200-day EMA right here. We're not going to talk too much about the price action because Apple is going to move a lot after earnings. They're probably going to move 4% up or down, so we will see. Up 4%, and you pretty much engulf the most recent leg of selling. It's going to look great to establish a weekly bottom and possibly a monthly bottom as well, as we know that we were just always in the quest of establishing a monthly higher low. Nice monthly breakout, retest of this exact level, which is why I was saying 250 to 245, well, 250 to 240, excuse me, was the buy entry level for any short-term short puts under the market, or possibly adding for a little bit of a share position on Apple. I think they'll be having a great Q4. Let's see what they say Thursday after the close. I don't want to predict what the short-term price action is going to be, only give you guys some levels. You break down after earnings, you're coming right back down here under 240 to a very big and logical area, 26 EMA, and the meat of the previous resistance, previous all-time high range. And you break up higher, well, you're heading right back up there, completing the monthly pattern of possible expansion into the 275 to 67 range of resistance. If you ask me what is my bias is bullish, just because we have their iPhone 17 numbers from Q4 and they are very good. So Apple is really going to have to kind of drop the ball from these earnings to go down, but we'll see what we get. Earnings is always a casino. Moving on to AMD right now, AMD down 3.22%. No news whatsoever, guys. I mean, AMD was up from the bottom here to the top. That was a 33% move in like 7-8 trading days. So eventually you are going to have to consolidate. We are dealing with the all-time high resistance range. Very natural pullback in my opinion, with a lot of space to work with right here. Higher lows are set right now at about 226. So looking for a new higher low, ran out of steam, couldn't get it done. Maybe just looking for a new higher low for possible further expansion. Of course, they have their own earnings next Tuesday, But if big tech raises CapEx guidance this week, a lot of money will probably flow into AMD. Weekly breakout uptrend looks very nice. And we know they spent the better part of the past 3 months establishing the monthly higher lows. So is AMD a good buy up here? We talked about it last week. Yes, it still is, but with a multi-year thesis, because if you're swing trading, right, you're a bit too far from being able to establish a local stop loss. The time to do it was really back here, and then just DCA into the trade all the way through the gap fill area. If you were building any long-term shares or leap call contracts or things like that, it is still a decent buy up here if you have a multi-year thesis and you want to see it through, but it's coming to the point where it's kind of like last call, right? You can still justify buys with the valuation alone, but let's be honest, you're not getting the best technical entry right now. That was at the low 200s. Moving on to Amazon right now. Let me just take off the volume because sometimes it's a little bit distracting from the charts. So Amazon as well has their earnings next week. We'll see what happens. They'll probably move with the rest of big tech. I mean, they're kind of in between right now, yeah? It's a daily uptrend. They gave back most of the move. They're trying for it again. They're trying to defend this area of support, 238 down to about 228. This whole area, weekly, is a nice uptrend, and the fundamentals for Amazon are good. The monthly uptrend is very casual as well. It's been a bit slow, but Amazon is looking for its year in the sun this year. Fundamentals are very strong for Amazon, guys, at 235, no complaints, 29 forward PE and a 1.48 PEG. A very strong company with very strong earnings last quarter. We'll see if they deliver again next quarter. I think they will. My bias is definitely bullish on Amazon. I have everything. If we come down for some reason down here into the 220s again, you guys know the drill. I'll be selling some puts. I'll be buying more shares. I do have leap call options from the lower 220 range. So maybe I'll build a few more of those leaps, but I do think Amazon is looking quite good into this year overall. And we know that, I mean, you got the greatest trader of all time is in huge Amazon leaps. So, well, I guess we'll see what happens. I guess we'll see what happens on Amazon, but it's still one of my favorite buys in the market. All lines of business executing perfectly. Moving on to Google right now. Google up 1.57% today. They have also earnings next week, not this week, but you know, just normal price action right now. It's a daily uptrend, nothing much to report right here. We're going for follow through. Pay attention, line in the sand is 319. Lose 319, daily downtrend, and maybe embarking into weekly consolidation because they haven't really broken new highs, right? We're trying to go for it, but maybe we're getting a little bit tired. It would make sense, weekly overbought conditions, monthly overbought conditions, but I don't really think they break massive structure. Like I don't really see a breakdown below 300 happening until their earnings. So perhaps Google might just stay flat until their earnings. Yes, they probably will move with the rest of big tech after their earnings, but I'm not really expecting a massive breakout from Google or a massive breakdown from Google much before their earnings. Very solid company, nothing bad to say. I'm not adding any shares up here though. I'm just holding what I currently have. Moving on to Meta right now. Meta, very nice day. I mean, they've rallied a lot since the bottom when we were saying it's a nice proposition, guys, right? Daily oversold conditions, huge area of support. This was 605 down to 557. And at that point, it was a really good valuation. It was under a 20 multiple. We're back to 673. But overall, Meta still trading low forward PE of about, low 20s at like a 1.6, 1.7 peg right now with an okay free cash flow yield. Meta, in my opinion, remains a buy. They do have earnings coming up on Wednesday, and the focus point of those earnings is going to be the expense profile and the CapEx profile, right? Mark Zuckerberg is going to talk a lot about his new venture into cloud services, which is something they haven't done before. So we'll see. But I mean, the chart was very clear, right? It was always looking for a monthly higher low, massive supports right here. It was a buy, 20, 25% off the highs, and you might just be looking for an upswing. I mean, they've been down a lot. So as long as he doesn't screw something up on the earnings call, my bias is directionally long into earnings. But who knows if for some which reason, just like last quarter, they just, the market just doesn't like it, and we find our way back into the 600s, I will be adding again on Meta, but I'm not really playing any swing trades into earnings. I've done most of my accumulating in this low 600 range already. Moving on to Microsoft right now. Microsoft was also a phenomenal buy. We talked about it last week too. Daily oversold conditions. How often does that happen on Microsoft? Not too often. And every time it does happen, it tends to be a nice local buying opportunity when you kind of just look at those daily oversold conditions. Indeed, as well, you had a beautiful, gorgeous backtest here. Prior all-time high resistance, support, 26 EMA, which never gets tested as well. So you just look at historical precedents. When you have these companies that are just so consistent, their business model doesn't change every single day. They're toll booth companies. They're some of the largest companies in the world. You can use historical precedents on the charts to let you know, well, when Microsoft comes down 20% off highs with good fundamentals, oversold conditions, backtesting of resistance, long-standing EMAs, is it a good buying opportunity? yeah, you can kind of almost close your eyes and be sure that, well, you know, I'm getting a pretty good level in terms of historical standards, right? Nice bounce on the daily, but they got to recapture the trend. They won't have time to do that though before their earnings on Wednesday. So we'll see what happens, right? Microsoft can move 5, 6, 7% after earnings. You do that from here, you're back above resistance range, and then maybe we can say that this was the monthly higher low for this beautiful monthly uptrend expansion leg. Maybe they'll be able to recapture the weekly trend as well in a two-step process and reverse, you know, 3-4 months of negative momentum. And at that point, if they somehow go down after earnings, right? Well, 450 down to 430 is my sweet spot for buying Microsoft. If they come down after earnings, I don't think it's going to be because they screw something up. It's just going to be, you know, because the market, it's just like last earnings, right? Microsoft had great earnings last time, but what happened? They popped and then they kind of just slow faded, popped and then slow faded. So if we somehow pop and then slow fade, you will find me buying some shares because nothing will fundamentally change about this position over the course of their earnings. As a matter of fact, I think it's attractive right now. Onto Netflix. So Netflix still doing a whole bunch of nothing. They did fill the earnings gap today though, very briefly, but still down about 0.5%. This one, no need to spend much time on it whatsoever. It's weekly oversold conditions. You guys know that it's been down for like 10 weeks in a row. It's the black cloud overhang of the Paramount deal, so no sense in talking about it. I'm just here to say it's a nice accumulation range. I'm not sure if we're going to find a bottom here or if they have to dip down into the 200 weekly EMA, which is at the 70 area. That's the next line of defense that we got down there. But Netflix is down 40% from the highs. At the end of the day, you got to ask yourself, is it a good buy down here or not for long-term shares? Yes, not for short-term swing trades because we don't have an established daily uptrend. So you can't say that this is the bottom. The bears control the daily, they control the weekly, and they control the monthly, right? So we can't really position short-term trades. You have to only be doing things for the long term, right? Long-term buys or possibly leaps. If you want to build a leap position down here, the valuation does say that it is quite cheap, 25 forward PE and a 1.3 PEG. Not too bad. Some of the cheapest multiples you've seen on Netflix on a forward basis, at least over the last few years, in my opinion. Moving on to NVIDIA. NVIDIA down about 0.64%. It's just not moving, guys, right? The past 6 months has just been a non-event for NVIDIA. There's been some ups, there's been some downs, but overall, it's just not moving. That being said, we're very close to support, 185 down to 178. Decent accumulation range overall. It's monthly consolidation, right? Now, obviously, best on NVIDIA is down here, 170 down to 165. You're not going to get that unless you get a big event in the markets that brings the Qs and the SPY down 4 or 5%. Then you'll see NVIDIA come down here, but you won't see it come down off of its own fundamentals. The earnings growth for this company is just ridiculous, right? They'll be growing earnings like, 60% year over year or something like that. So looking at 175, the price to earnings multiple on a forward basis is like low 20s. And it's a 1 peg. So NVIDIA is not expensive at all. So I am indeed accumulating here. Every time it dips meaningfully, intra-week or something like that, I'm selling some put options down here as well. I'm in a few things right now. I'm in leaps, a few shares for accumulation, or just selling puts down here. Decent. Eventually, NVIDIA will break out, in my opinion. It's just been slowly consolidating, as it does sometimes, right? These slow monthly consolidation phases. Well, this was tariffs, but this is just another slow consolidation phase for this stock overall. But they have cooled down the monthly RSI. They've cooled down the weekly substantially. The daily is nowhere close. So, when they do break out, what I'm trying to say here is they got some room, right? My price targets for NVIDIA by the end of the year should be like 250, 270 would be where it achieves fair value, because now I think it's a little bit undervalued at the current time. A few more. Tesla's earnings on Wednesday, and you guys know Tesla moves 7-10% after earnings. So, impossible to comment on the price action. You guys know the drill, right? It won't be focusing on the car business. We already have their deliveries numbers. So you can extrapolate, their margins and their deliveries and their revenue from the car business. No, we know that Tesla doesn't really move off of that. Tesla moves off of Elon's commentary on the long-term positives. How fast can they scale FSD? How fast can they scale Optimus? How fast can they scale their energy business? Those will be the focal points of this earnings again. The chart's not looking bad though, guys. Long-term timeframes here, monthly, looking for a monthly higher low. If we get any further declines after earnings, maybe some of you get your buying opportunity if Tesla somehow drops here to 400, 405 down to about 380, 12 EMA pocket, monthly, just perpetual consolidation here before possibly another move. And prior resistance is current support. No positions for me right now on Tesla for any short-term swing trades, but I do still have a couple hundred shares that I will be holding into the future for the long-term thesis overall. Actually, no, I don't have a couple hundred shares anymore. Under 100 shares for me on Tesla right now, as a matter of fact, about 60 shares. Moving on to Palantir. Palantir, 1.26% to the downside. This play has just not been really doing anything. Unfortunately, resistance is above us, 186 down to about 170, right? Daily, still looking like it wants to complete the pattern for a daily downtrend. I mean, we'll see. Maybe this company has a huge rally and can break up, but the time frames right now are showing us that Palantir just wants to consolidate a little bit, and it has been wanting to do that for a better part of the last 5-6 months at this point. Doesn't mean that the stock is not good. It just means, just like NVIDIA, it's the same setup, right? Just rallied beyond the highs. There's been some ups, there's been some downs, but relatively in the volume profile range. Even though I don't have it up here, you can just clearly notice that most of your trades have been made in this area. If you do dip a little bit lower, it could probably come down to the 12 EMA down here, 150 down to 140. This is maybe an area that I would be interested to further position in, but we know that Palantir has just been trying to catch up to its own valuation. I don't think their earnings are going to be bad. As a matter of fact, I think once again, they're going to blow us away with their earnings next Monday, but this stock is probably not going to move much before next Monday. I'm not expecting a big breakdown towards here by next Monday, nor am I expecting a massive breakout before next Monday. I think we'll just have to wait for their earnings. Moving on to SOFI. SOFI also has earnings on Friday. I don't think this stock is going to move in a meaningful fashion before their earnings, so no sense in talking about the price action before then. SOFI is usually one that does move about 10% up or down after their earnings. If you ask me, I think they're going to post good numbers, but we obviously know the market is a casino. SOFI has posted great numbers every single one of their past 4 earnings, but look what's happened, right? You move up, and then you kind of slow fade, kind of like Microsoft, right? Move up, you slow fade, and then you rallied. This one right here, you moved up, you gave it back, and then you kind of slowly increased. So, you got some history, right? Right here, they went down, as a matter of fact, after their earnings, but they never missed. Like, all their earnings are good. You know what I mean? No big misses. I'm expecting SOFI to grow its customer base, grow its product suite. I'm expecting Anthony Noto to say some really good things on the call, but if for some which reason Wall Street doesn't like it, you are coming down here into support, 25 down to 22. I think it would be a great buying opportunity because it's just been consolidating now. Very healthy monthly chart, in my humble opinion. And obviously, if you get the 10% breakout higher, which some people are expecting, and I truly hope as a SOFI investor myself, I truly hope that happens, but you got to crack 30 to 28 and hold above. We can't just give back the moves like we did last time, right? You got to break it, hold the weekly, and then you'll know, all right, great. We took out all these people here on the order book, and now we can sit on top of it and possibly build into that rally into 2026. But it's looking good. This has been a nice big accumulation range. I'm not opposed to buying shares at 25, nor am I opposed to buying more at 22 if it drops down there. That's what I've been saying over the past 3-4 months, every single time we've been down into here. Moving on to the 2 last ones, Uber and TSM. Uber, just a slow fade. Uber also has earnings next week, so I don't believe that Uber is going to massively break down here towards the mid-70s, nor do I really believe they're going to break out above 92, which is resistance before their earnings. We will just have to wait. Uber is decent value down here. Very decent value in my humble opinion. If you take a look at the monthly timeframes, it's just slow monthly consolidation. A common theme across this list right here, slow monthly consolidation. For the past 3-4 months, a lot of these companies on this list haven't really done much, right? Now, moving into the valuation at $80, trading at a forward 23 PE, 1.43 PEG, and a 5.25 free cash flow yield, which is very attractive. They should be putting up really solid numbers, guys. Monthly active users, booking trips, everything should be good. But for further positions from me, I will probably be waiting for earnings at this point in time as we're a bit too close. And I don't usually like positioning to speculate on earnings. I'll just rather wait to see what the company says and see if we can find any trades thereafter. Moving on to TSM. TSM down about 0.65%, but they had fantastic earnings and sadly they just came down. That being said, there's nothing wrong about the company, right? Daily, nice uptrend right here. Pay attention, the line in the sand is 326. You lose this, you get the daily downtrend, you get the weekly consolidation, and maybe just heading back here, 310 down about 300. Very attractive area overall for a bit of a back test and policy run. Fundamentals on TSM are very strong at 340, mid-20s forward price to earnings, a 1.4 PEG, a 9 forward price to sales metric, So it's not expensive, but then again, TSM never really does trade expensively because it always has the China threat that hangs above it, right? So TSM always usually trades low to mid 20s multiple. It doesn't get that big expansion, unfortunately. So you kind of got to trade it in waves. When they do come back, then we can kind of trade it on the next leg higher. For me, I'm just holding all of my shares in TSM right now. I'm not really buying any more up here. And that's everything I had for you guys for the overall market rundown. Now, let's get into the biggest gainers and losers of the day. All right, we're going to start off this biggest gainers and losers segment. And I always like to give you guys some some lessons, right? Across when we do this biggest gainers and losers, we've talked about the theme so far. So you guys know all the themes, the space theme, the critical minerals theme, etc. But the lesson that we'll go over today, guys, is you always have to ask yourself one question when you're looking at some of these plays, right? And we'll talk about them. And the question is, are you buying the stock or are you buying the business? And you may think that it's the same thing, but in all reality, it's not. Some people buy something under the premise that they're buying the business, but actually what they want is they want the quick and rapid, juicy gains. When you get a news headline like USAR, the government taking a $2 billion stake, $1.5 billion to be specific, $1.5 billion stake in the business, well, many people just clamor to this stock and then end up disappointed when it goes down saying, oh, I bought the top. Once again, are you buying the stock or are you buying the business? Buying the stock all the way up here under the premise of the long-term government investment. Well, keep in mind, it is a long-term government investment. When we're talking about some of these critical mineral names, right? Keep in mind, a lot of these critical mineral names like MP and USAR, they don't have any revenues. You guys know how long it takes to start up a mine and scale your operations into some form of profitability. It takes a long time. This company currently trades right now at a $4 billion valuation. That is 10 times Ford 2028 sales. So I know that sometimes when you get these big hype and big narrative driven moves, right? Sometimes people don't care about the valuation. And that's the type of person that doesn't really care about the business. They only care about the stock. You're buying the stock. You're not buying the business, because anybody who's buying here, there's two types of people. Somebody that's disappointed that they faded almost the entire move, but some other person who's buying it with a 3, 5, 6, 7 year time horizon and saying, well, I'll buy some here, and if it goes down a little bit more, then I'll just hold it for the next 2, 3 years, as I know critical minerals reshoring towards the United States is a long-term thesis. The USAR did very well, but other names, unfortunately, did not do too well today, such as quadruple U's or many other popular stocks. UAMY were down today. Some people view this as a buying opportunity. Other people will be quite disappointed that UUU, MP Materials all went down. MP Materials is the exact same concept. It's an $11 billion stock right now with direct government investment, but where are the revenues? The revenues are very far into the future, right? 2027, 2028, they'll be making about $1 billion per year, roughly. That is a 10 times forward price to sales metric for a mining company. Usually they don't get that type of valuation, but when you include some government funding, right, and you include heavy amounts of retail interest and momentum, well, that's when you end up with higher valuations like this. So although you may be disappointed and you might have assumed that MP Materials might just launch today, and maybe you bought the top of the open and just got disappointed that it brought you all the way down, well, are you buying the stock or are you buying the business? If you're buying the stock, we can make an argument that, yeah, we're looking for a weekly higher low, possibly for some momentum with a stop loss below there and a price target all the way to the all-time highs. But if you're buying the business, well, you would buy with a long-term time horizon. So the question I'm asking you guys when you're asking me whether it's a good time to buy these things is, well, what are you buying? Are you buying the stock for some momentum, in which case trade with a stop loss? Or are you buying the business, in which case hold the stock for the next 3 to 5 years and let your fundamental thesis follow through? Same thing can be said about some of these space companies as well, right? Rocket Lab, right? Rocket Lab, I was saying, was a great time to buy down here for the business, because at that point, the fundamentals made decent sense. I'm not saying they don't make sense up here. It's a phenomenal company. They'll be around for the next 5, 10 years, and I would not be surprised if Rocket Lab over the next 5, 10 years is much higher than here. But once again, we always got to be sure, where are we buying, right? At what valuation of forward multiples are we buying? When we last did their valuation down here after their earnings, when they were down here, I was saying that, you could somehow still justify these valuations if you are a very long-term investor, because they're trading at very high price to sales multiples, right? You will never get the amount of returns that somebody who bought back here is getting, or back here. But when you play these at very steep discounts from their highs, you can justify this, right? But now when you lose the daily short-term structure and you're going into some form of weekly consolidation, well, maybe we should be targeting areas of former resistance, which is current support, or at least allow the monthly timeframes to cool off a little bit. We know this space trade started off 2026 with a banger. I mean, from the lows of December, just in 2 months, guys, this stock was up 150%. It's like, how much more do you want in an absolute straight line? So once again, are you buying the stock just because it has momentum up here, or are you actually buying the business? The last thing that I want you guys to do is you say you're buying the business, but then when it goes down like this, you don't want a DCA. Well, that's not you buying the business. That's you buying momentum and getting trapped and being forced to be a community member and being forced to do your research on the business because you're down. You may as well do the work before and then understand that when we have these pullbacks, maybe then it's an interesting ad for you if you want to play the business. So Rocket Lab for me, I mean, the last time it was a buy for me was like 40 to 50. If we somehow drop a little bit right here into maybe the, I don't know, low 70s to 60 range perhaps. I know some people don't want to hear that, but this is all just normal price action, right? It was there before. So nothing's changed fundamentally here, right? If they just move a little bit lower, maybe we'll see. We'll check on the price action if we see turning events like we had here, right? When they find a local bottom after a nice slide, and then you reverse the daily time frame, and I position here, and I get most of this move. Well, then maybe when they do this, they go into consolidation, and then you find another turnaround, establish a weekly low around support, change the daily time frame. Maybe then I can make a swing trade on it. But as of right now, no. But is Rocket Lab a stock that if I were in from all the way down here, would I be holding it? For sure. Of course I would, because they're doing great things. It's a solid company with a very good CEO. So keep that in mind, right? Once again, are you buying the stock for some short-term gains, or are you buying the business? If you're buying the stock for short-term gains, just understand, when it's already up 150%, well, maybe you're not getting the best risk to reward. Just maybe, just a thought, right? Same thing for Ondas, right? Once again, are you guys buying the stock or are you buying the business? When everybody's talking about it on social media here, because Ondas from the start of the month of January is already up 82%, and you just want to participate because so many people are posting gains, then you buy the top, then it starts coming down. Well, then you start doing some research into the business, right? How about we do the research before and then corroborate that research with some nice backtest entry levels, right? So Ondas for me, if we come back down here, maybe like the $9 to $8 range, that's kind of my sweet spot. Some people don't want to hear that it's going down there. It can always pull down there. These names are super volatile. They go up 8% in 2 seconds. You know what I mean? Goes up 8%, goes down 2%. It's just a high beta, high momentum name. So that being said, are you investing in the stock or are you investing in the business? If you're investing in the business, well, you want to get the best buys possible, and then you will hold, right? If you're looking for a trade, well, maybe you want to wait for this weekly consolidation to play out in the support range and maybe wait for them to recapture the daily uptrend, because when you recapture a daily uptrend, just maybe it leads to a very nice move, right? As opposed to just buying somewhat of daily consolidation and saying, well, this is the bottom, this is the bottom, this is the bottom, and I just want another 80% rally. Please just send it up 80% in 2 weeks again, just so I can have the same juicy gains that people had when they bought actual back tests of the 12-month EM8 on this first consolidation phase for the stock. So kind of got to let things come to you at a certain point, guys, and not just buy at any price because you see it on social media or whatnot. Good company, great products, drones, very easy thesis for this here, but play the waves, please, right? That being said, I mean, we can apply that same logic to many names in this, the names that are down this morning, the names that are down today, excuse me, right? Some of the battery names, EOSC down a little bit. EOSC for me might be a little bit of a pickup here, 13.5 down to 12 if we ever find some movements down into that area. Same thing for FLNC. FLNC is the one that I have. I don't have EOSC, but FLNC down here, low 20s is indeed a big buy for me. I like this company. I like their battery technology overall, and they will be highly utilized. So if you give me a backtest here of phenomenal previous big area of price action, you might find me adding to my position. That was the last time I built a position. If they give it to me again, you might find me buying all the way down there. So those are just a few of the battery plays that we can talk about. We can talk about other ones, perhaps, maybe like something like an Affirm. Affirm for me, if you guys don't know, Affirm is a buy for me down here. They have earnings next week, so I wouldn't fault you if you wanted to wait for their earnings release. But Affirm, I mean, just on the valuation alone, guys, it makes a lot of sense. Monthly consolidation alone as well, it makes a lot of sense. They're growing their business really well. They're growing their net profit margins. They're growing their merchants that they have access to. They're growing their customer base a lot. It's my favorite buy now, pay later play. And I think it could do quite well in a consumer expansion cycle that might come. It's a no recession thesis, it's a soft landing thesis, but Affirm is indeed a trade that I really like a lot. We can talk about some of the data center names, Nebius, IREN, and all that good stuff. They were down today for no specific reason whatsoever. Nebius for me is indeed a buy under 80. So if it comes down there, I might be adding a little bit to the same effect. IREN for me is a buy. If we start coming into the 40 to low 30s range, just looking to play the waves, right? We had a nice little upswing right here. If for whatever reason they offer a re-entry opportunity down there, I mean, they do have earnings coming up, next week. So if ever we find our way down here, either before or after earnings, you might find me adding to a little bit of my share position, just rejecting from resistance right now. If you guys enjoy CIFR, it's up to you. If you enjoy APLD, it's up to you. If you enjoy Wolf, it's up to you. Truly, the ones that I'm invested right now are CoreWeave, NBIS, and IREN. Those are just the ones that I'm in personally right now. I think that's kind of it, guys. I mean, Trade Desk is down 8%. I can't really realistically touch this stock. To be honest with you, they're competing directly with Amazon, and Amazon is just killing their margins. And to be quite frank with you, even at 40, I mean, it wasn't dirt cheap. It's getting cheaper, right? But they won't grow this EPS growth rate like this forever. So, you know, even at 40, I mean, now I understand that at 33, it's like, you know, a full, what is that, like 20% lower than that right now? So right now, the forward PE rate is still a 30. It's not a 20, it's not a 15, right? So we'll see. Trade Desk for me is a bit untouchable right now. There's just a lack of clarity, and they're competing directly with Amazon at this current pace, which is why I can't really touch this one overall. I mean, there's a few other ones in here, but we've talked about them many times overall. I know some of you guys want me to cover these every single day, but it's just not realistic, right? So we'll just cover some major themes, and hopefully when I give you guys the technical lesson or psychological lesson of these trades, hopefully you can apply them to other things. What you're seeing right now is just a rotation down. Many of these sectors, right, that did really well to start off the year, whether it was a space theme or drones like AVAV, military trades, right? Like look at AVAV has come down substantially. You know, some of the military defense names like RTX, right? You just look where they are in the monthly, yeah? RTX, LMT had a significant rally as well. So eventually they will have a leg down, and that'll just be normal market rotation for names in those whole themes, right? Critical minerals did a really good start to the year as well. They're coming down. Space trade, really good start to the year. They're now coming down. ASTS is the exact same logic as well. Who knows? Maybe they bottom from here and go for another 80, 100% rally. I hope that's the case for you guys overall, but just don't be disappointed if it doesn't. And to the upside here, I mean, I guess we can cover a few more. I mean, the video is already super long. I may not have time to do the portfolio today, sadly, because if not, it's going to be over an hour and a half, which is what I don't want to do. But the time of these long videos are coming to an end, guys. I spend the full month of January doing long videos like this for you guys, but I'll be traveling come Friday. And as a result, the videos will be a lot shorter when I'm traveling. And when I get back, I'll kind of keep them under an hour as well. So we'll cover, you know, less of the overall themes, less of the overall things of that nature. And I'll just go through normal price action, but we'll always be doing it in the Discord. So shout out to you guys if you want to join us in there. Cloudflare coming up a little bit today. Breathe some life into some of the cybersecurity names. It's still somewhat of an unconvincing move, right? Because at the end of the day, they've just been straight down, looking for monthly higher lows. All of them. This one, Zscaler, Datadog, right? They're all looking for monthly higher lows, and they got some really nice pushes today. CrowdStrike is also a company that's looking for monthly higher lows. As you can see, looking for monthly higher lows. Palo Alto Networks is also a company looking for monthly higher lows, right? Low, high, higher low, looking for the expansion move. Rubrik is also a company looking for monthly higher lows too. I'm personally in Rubrik and Sentinel-1, so take from that what you will. But cybersecurity looking pretty good in terms of like a bottoming out process for some of these names. Just depends which one you want to play. And that was just a lot of the ones that were on the highs over the course of the day today. ANET, you guys know my stance on ANET. It was a buy, clear buy down here, 120s. I said it a lot over the past few months. So maybe you guys are able to position. Melly is clearly a buy for me. We talked about it a lot down here in the 2000 range. It's still a buy, even though you're not getting at the lows. Reversing the weekly timeframes a little bit. Weekly MACD cross as well. And just still looking for monthly higher lows on Melly as well. They barely clipped into it. 2060 MA on the monthly. Solid level for possible appreciation this entire year. So that's kind of everything that I had for you guys today. I mean, sure, there's many names. There's like 200 names on this list, but we can't possibly cover everything. So I kind of go over the main themes and the major rotations that I was noticing on a day like today. And hopefully you guys can take that and do a little bit of your own legwork into what names you prefer in those overall rotations. And I'll try to cover as mmany names as possible. That being said, so that's going to be it for today's video. I'll try to do the portfolio tomorrow. I'll keep tomorrow's video shorter. And I will do the portfolio. And that's going to be it for me today, guys. So if you enjoyed today's video, consider dropping a like, consider subscribing to the channel as well if you're new. And last but not least, if you have any questions, please feel free to leave them down below in the comment section. Always enjoy answering your guys' questions, comments, feedback. And also, if you guys are looking at certain stocks, definitely let the comment section know. Always curious to hear about your guys' plays as well, because I can see a lot of the things in the market, but I can't see everything. So if you guys want to shout something out, just let me know, and maybe I'll add it to the watch list or something like that, or maybe we can cover it in the future. But that's it for me, guys. and coming down to the end of the long format videos. I promise, I've been saying this for a long time, but now moving forward, like, especially when I leave the country on Friday and I'll be traveling for a month, right? You guys can expect now videos in the 45-minute to 1 hour range. So there'll be less biggest gainers and losers of the day, less total news elements that I'll cover. You know what I mean? So we'll try to keep it shorter and sweeter, but hopefully the last 2 months, as we've moved into these new themes and new news cycles and things like that, hopefully now you guys know where I get my reads on the market and how to kind of view things in a in terms of the sum of all parts, right? So that's it for me, guys. Take care. See you guys tomorrow after the close. Peace.